Hello and welcome back to the Note. We've come full circle at last this week. The S&P 500 gave up more than 10% by the middle of February. It's regained all of it. It's up slightly for the year. Many other indices around the world, not just in the stock market, have similarly seen a big V-shaped dip and recovery in less than 3 months. Let's take a look now at some of the things that have actually changed nearly a quarter of the way through the year. Now, first of all, let's take a look at one of the ways you really could have made money, which very counterintuitively was to put money into Petrobras. This is the classic leveraged play, using the equity to make a leveraged play on the underlying commodity. Oil itself got above $40 a barrel for the first time in a while this week. Petrobras, obviously the victim of a very severe scandal in Brazil, despite the fact that that scandal is getting ever worse, is now sucking in both the current president and the former president amid riots on the streets. Despite all of that, because there is excitement that this at least means that the scandal will be resolved, that means that the Brazilian currency is recovering, as you'd expect with oil recovering, and as a result, Petrobras has been a great bet. It's virtually doubled since February. It's up well over 20% since the beginning of the year. A fantastic way to profit from the change in the oil price. Bear in mind, however, that if oil continues to strengthen like this, it will strengthen the hands of the current government in Brazil and might reduce the chance that we'll finally reach a resolution to that situation. Next, let's take a look at gold. If you want one very worrying sign that things have changed, gold has been in a bear market for several years. It's up at one point almost 20% for this year. Plainly a sign of some underlying worry either about central banks or about a possibility of a return of incipient inflation, or both. If you had bought the GDX Gold Miners Vectors ETF as a leveraged equity play on gold, as you can see, you would have made an awful lot of money very quickly. But it's also very important, I suggest, to note that the gold price has risen as much as it has. That's good if you happen to be holding gold. It's a sinister development beyond that. Now, why might gold be rising? Let's take a look at this next chart. There is a sense of concern, of needing to see the cash, the money, a loss of confidence, which shows elsewhere in the markets. What we're looking at here is the S&P 500 Dividend Aristocrats Index, an index that just includes the most reliable dividend payers in the S&P, which tend to be relatively boring conservative companies. Compared to the S&P, you can see that they have suddenly started performing very much better. And again, that is something that hasn't particularly corrected during the rebound of the last few weeks. When people are saying, show me the money, much as when they're deciding they are buying gold, that is a sign that they lack confidence and perhaps that they are worried about inflation. Now that brings us to a final chart which shows you inflation break-evens. This is the implicit forecast you get for inflation by comparing the yield on inflation-linked bonds to the yield on fixed income bonds. And you can see something quite interesting. We obviously had a very severe deflation scare. That was a big part of why markets sold off at the beginning of the year. The dovishness by a number of central banks, including now the Federal Reserve, which is dialing down expectations for rates rises later this year, is interesting because here in the States there is a sign, as I said earlier this week, that inflation is actually picking up. As you can see from the green line there, which shows you implicit expectations for inflation over the next 2 years, there's been a very sharp pickup in inflation expectations. You can also see that over 5 and 10 years after very great lows, there is also again a noticeable rise. Now bear in mind that the Fed's target is there, 2%. None of these measures are yet up as high as 2%. It's certainly too early to start worrying very greatly about great resurgence of inflation of the kind we saw in the 1970s. However, you see this inflation expectation picking up quite sharply. This is the kind of thing that the Fed worries about. All other things equal, you would expect it to mean that the Fed would feel able to raise rates from as low a level as they are at present. This is another sign that while the kind of easy money we've seen has been enough to allay the concerns about stocks and the economy. There is now growing worry that this may come at the cost of resurgent inflation here in the States and perhaps faster rises in rates later in the year. That, I suspect, could dominate the agenda for the next few weeks to come.